Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.
And now introducing Mr. Keith Lanton.
Get started this morning. Happy Columbus Day, October 14th. I want to remind everyone that this morning that government bond markets are closed. Most bond markets participants are not in today, so trading will be very thin. So we're going to get started this morning. Want to talk about a topic that we all are keenly aware of, and that is the low interest rate, low inflation environment that we're in. I want to give some food for thought on the current environment, and perhaps some explanation as to why we are currently in a low interest rate, arguably negative interest rate environment in a 15% of all securities, and why that may be. And you can certainly come up with counterpoints on why inflation may rear its ugly head and why interest rates may go up. But I wanted to focus on perhaps some non-intuitive thoughts on why interest rates may persist at very low levels for a lot longer than perhaps we think. Of course, when we start talking like this, the next thought that pops into our head is when we start thinking like this, that means that we must be on the verge of rates going up if we think rates may stay lower. But I want to give some interesting thoughts, some things I've been thinking about on the low interest rate environment. I mean, one factor that we all must keep in mind when we look at interest rates is where our mindset, our vantage point, where are we looking from? Views look a lot different when you're at the top of the mountain than when you're at the base of the mountain. And most of us in the business and most economists came of age in an era of inflationary environment post-World War II. We came of age in an environment where we had a baby boom going on, not just in the United States, but throughout the world. And we also came of age in an environment where we experienced the oil shock in the early 1970s. That was really the jolt that got inflation really kicking, and the OPEC cartel really pushed up the price of energy, and that helped fuel inflation. And that really set many of our expectations of what interest rates should look like and what inflation may be. And the reason I point that out is it's really just a 20 or 30 year period that we're focused on. But for most of us in our lifetimes, that was a 20 or 30 year period that was very formative and had a great influence on how we think as investors with respect to inflation. That same phenomena takes place as well as with economists, many of whom are the quote-unquote experts on where interest rates or inflation will be in the future, and a lot of them were subject perhaps to this, let's call it the bias of higher rates based on their personal life experiences. If you look out throughout the course of history, the events between 1965 and 1982 were historically unusual, yet to us they felt very normal. So speaking of inflation, we had an event just last week in our financial services industry that is exemplary of the push down on prices, and that was Charles Schwab's announcement that they were going to reduce commissions to zero for online equity, meaning stock and options outside of the cost of the contracts for options. They were going to go reduce that price down to zero. Now, if you think about that move by Charles Schwab, certainly is something that's disinflationary or causing prices to fall. But that came about because technology enabled companies like Charles Schwab in 1975 to start charging less for stock transactions, also known as the discount brokerage. And what Charles Schwab did in 1975, whether we knew it or not, and not just Charles Schwab but other disruptors as well, is they really were the initial thinkers of separating out the advice component and the transaction component of securities transactions. Prior to 1975, advice and execution were built in together. But technology was a driving force enabling Charles Schwab to be able to separate out the costs of doing a transaction from the costs of the advice of giving that transaction, and thereby a new business was born, and that was the investment advisory business, where advice was given for a fee, and the transaction cost for the transaction was driven lower. What we've ultimately seen is the transaction costs coming down to almost zero for transactions, or 2-0 for equity and options transactions. Why is that? I would argue that this is just the beginning of machines replacing people for tasks that are commoditized and can be done automatedly. Because really, what is online trading and enable Charles Schwab and TD and others to do? It enables them to utilize computers, artificial intelligence, and algorithms to efficiently and effectively execute stock transactions. Now, this is not just a purely altruistic exercise. They have reduced the cost to such a level that they can provide that service at little or no charge, but provide ancillary or other services or add-on services for a fee. And those services, as many of you may be aware, are things like charging for margin interest, charging higher rates than much of the market, for providing banking services, for providing wealth management services, and for offering lower yielding money market rates than their competitors. So something to think about here just in our business: disinflation, negative inflation because of algorithms, artificial intelligence. If you want to do a transaction with one of those brokerage firms that are offering the zero cost transaction, and you want to speak with a human, different process. You want to do a bond trade, different process. There's still a charge, still not inexpensive. Why? Because you still need people in order to get those transactions done. So one example right there of lower prices. Why are we experiencing these lower prices? One example right there: technology, and we'll certainly talk about that. But two other factors are taking place at the same time, also resulting in perhaps lower inflation or even no inflation. One of those events is truly unprecedented in the history of humanity, and that is longevity. People are living longer, and it's not just in the United States. The rest of the world is starting to live a lot longer also. And as people live longer, they have much longer retirements. Historically, people initially worked literally until the day they died. Then we had the Great Society and President Johnson coming out with the Social Security Administration. Social Security Administration said your benefits kick in at 65. Average life expectancy was 67 or 68, so you really didn't need your money to last a whole lot longer than from retirement. But now, people being logical creatures, people being intelligent, people also knowing that the human body, even though we've made lots of progress, in general, it's a lot harder for the human body, especially to do labor that requires physical exertion. People still can't work at the same pace that they did when they were 40 or 50 as they can when they're 70, 80, or even 85. So people being logical know that they need to save for a rainy day, and they need to save for a long time for that retirement. So what are they doing? People are saving a lot more of their income as they live longer than they historically have. Very logical choice, knowing that they are going to need funds to sustain them through that long retirement that is in all probability going to be part of their future. One factor, technology. Second factor, longevity. Third factor, population decline. While not unprecedented, extraordinarily rare in the history of humanity. Historically, the only times that we experienced population decline were as a result of war, famine, and disease. Here we are experiencing the potential for population decline, not for any of those factors, but because of the fact that people are starting to have less babies throughout the world as contraception, birth control reaches not just developed markets, but the developing markets. We are seeing populations declining. And when we see populations declining, we also see at the same time, perhaps more importantly, we see populations aging, going back to that longevity factor. So longevity in association with or in conjunction with population decline, meaning people having less babies, means there's a much greater percentage of the population than has ever been the case that is older. And therefore what you have is you have a lot more people that are demanding money, inversely, a lot more people who are supplying money. As they age, they are not spending, they are saving, they are money suppliers. At the same time, you have less demand for money. Who demands money? People who are younger, people who are going to borrow against the future earnings that they are going to have in their future. So if you think about it here, what we have taking place is we have a total different supply-demand equation. Historically, we had more demand for money, less supply. We had a lot more young people in the world, a lot less older people. Now we have a lot more older people who are suppliers of money, a lot fewer younger people who are demanders of money. As that balance gets out of equilibrium, we have a potential for lower interest rates. After all, interest rates are just the result of the demand and supply, or the price of money. Against all that backdrop, we started this conversation with technology, and we talked about how computers and artificial intelligence are affecting the brokerage industry. But it's not just, obviously, the brokerage industry, and it's not just the effects of computers. It's the effects of the fact that we can have rapid transportation of goods and services throughout the world, and this has created the effect. If you go back and think about it, and you go back even 100 years ago, and you wanted to buy a hammer to build a house in a rural town, you really had very limited options. You went into town, you went to the local hardware store, they told you the price of the hammer, you either bought it or you substituted. You said, you know what, I'm not paying that much money for that hammer. I'm going to use another piece of wood, and I'm going to use that wood. It's not as good to bang in my nails. Really very limited options. Go back maybe 50 years ago, you had an option. You can go to the hardware store, or maybe you can go to the 5 and 10 store and get maybe an okay hammer, but a lot less money. Then you had Walmart, maybe 25, 30 years ago, become a viable competitor and offer you that hammer for a lot less, driving out that local hardware store. And now you have the internet, where you've basically got a virtual plethora of hammers available to you from the likes of Amazon, driving down the cost of goods and services. At the same time, you also have the potential of substitution, not just substitution within a specific good, not substitution if I'm not going to buy a Ford, I'll buy a Chrysler, but substitution on big items, big events, because of technology. And I'll give an example of substitution is in the energy space. If we went back to the early 1970s and you had a house and a car, in all likelihood you needed oil to power that car for gasoline, and you needed oil to power your house. No choice. OPEC said price of oil is going from X to Y. You as a consumer now must pay Y if you want that energy. Take a look at where we are in 2019, and perhaps the future will even be more looking like the present that I'm talking about. But today, if you spike the price of oil and gasoline, very likely people will start considering hybrid vehicles or electronic vehicles. If you hike the price of oil and your home is powered by heating oil, very likely you will call up your local utility and see if gas is available in your hometown. If gas is not available, it's very possible that you will consider putting solar panels onto your roof in order to meet your energy needs. So the potential for substitution given technology is so tremendous. The same could be said about cars. If cars go from a cost of $30,000 to $60,000, virtually unheard of a few years ago, now you might instead of purchasing a car, or instead of purchasing 2 cars in your house, maybe you'll purchase one and you'll take an Uber to the train station. So the effects of all these events taking place are having a dramatic effect on the supply and demand of money, and we will see how that plays out over the next 20 or 30 years. But as we start considering what's the appropriate rate of return on our investments and our fixed income investments, it's important to think in terms of why the world may not look the same as it did in the 1970s. So, going to get started this morning. I am going to talk about Barron's headline story, somewhat congruous with that thesis that we just went through. And Barron's ran their headline story, "The Best Income Investments for a Low-Rate World." And I'll also talk about a Barron's article where they said that the long rally in bonds might be near its end, so give a countervailing viewpoint to the thesis I just laid out. So where are we right now? Let's take a look at last week. Last week we had news reports of a deal, or at least I should say a first phase deal between the U.S. and China. And at the end of the week, that led to a rally in the financial markets, pushing the markets up for the week. We saw the Dow up just under 1% for the week, and the S&P up about 0.2% for the week. NASDAQ was up just about 1% for the week as well. Foreign stocks dramatically outperformed the U.S. last week, up 2.3%. Emerging markets up 1.5%. For the year, U.S. stocks still up on roughly about 20%, 22 for the NASDAQ, 20 for the S&P. Foreign stocks lagging for the year, 14% on average, and emerging markets up just about 7.4%. We saw a meaningful backup in yields, meaning interest rates did move higher last week, but still very low by historical standards. 10-year Treasury around a 173, 30-year Treasury just over 2.25. So again, historically, still looking at very low interest rates. Also, just moving back to last discussion there regarding the interest rates and the population effect and the older people in the world. If you look at where there are negative interest rates, in particular Japan and Europe, those are the areas where you're seeing the greatest population decline. So perhaps some evidence of the thesis that we see taking place with respect to interest rates. If you look at the United States is expected to have slow but marginal population increase or rise. So perhaps it's not surprising that you're seeing negative rates in slow population growth or negative population growth areas, and seeing slow or low inflation or low interest rates where we see low population growth. Something to continue to monitor. This morning we're seeing futures falling on reports that China wants more talks before signing Phase 1 trade deal. The S&P is down about 6.5 points. The Dow's down 55. The NASDAQ down 18. Oil this morning down about $1 a barrel. Also in Europe, there is some reports that there's some more concerns on whether or not a Brexit deal can be reached. That's also pressuring U.S. futures this morning. Some companies in the news. Nike was upgraded to neutral from underperform at Bank of America, up about 0.5%. Western Digital is up about 1.5% this morning, upgraded to buy from hold at Loop Capital. Asian markets ended higher. China's market was up 1.2%. Hang Seng up 0.8%. The Nikkei was closed. China's trade surplus came out $39.6 billion. It was expected to be at $33.3 billion. So trade surplus in China significantly higher. General Motors and their unions remain on strike. Interesting to see over time what effect that may have on the U.S. economy as that strike goes on longer than anticipated at General Motors. So moving on to the story about the best income investments for a low-rate world. Barron's ran the headline article pointing out that the world seemingly turned upside down, something we talked about this morning. As a matter of fact, last week, Greece was able to issue debt with a negative yield. Greece was on the verge of insolvency just a few years ago now, issuing their sovereign debt at negative interest rates. When you compare that with countries like the United States with treasuries yielding over 2%, you can see why capital is flowing into the United States. So Barron's saying, where should investors look in this low interest rate environment? And I'll give you a few different thoughts that they have, and they provide a list of some thought, just going through it by category. Number one, they say look at short-term bonds. Given the narrow differential between short and long-term bonds, there's a good argument for staying short. Money market fund yields have fallen below 2%. They could drop to 1.5% by early 2020. So they suggest looking at some short-term bond funds that offer higher yields. They talk about the PIMCO Low Duration Income Fund. That fund has about a 3 to 3.5% yield, depending on the share class. It does have a significant position in mortgage securities. They also talk about the iShare 1 to 3 year Treasury bond ETF. Symbol is Sam Hotel Yankee. That yields 2.1%. Does have the added benefit of holding treasuries, which for those who are in high tax states can enjoy the state and local tax exemption that treasuries do offer. Taxable bonds, next category. They name a few different funds. They talk about the PIMCO Income Fund, PONAX, yielding just over 5%. The Double Line Total Return Bond Fund, Delta Lucky Tom November X-Ray, Luma Sales Bond Fund, and the John Hancock Strategic Income Opportunities Funds. They do point out that some of these funds, although they do offer attractive yields, have lagged behind recent returns in the Treasury market because they have been positioned more defensively, and we did have a big run-up in bond prices. And being more defensively positioned, they have lagged recently, but perhaps with the slight pullback I mentioned earlier in Treasury rates, that caution was warranted. In the emerging market bond space, they suggest taking a look at the J.P. Morgan U.S. Dollar Emerging Market Bond Fund. The symbol is EMB, Eddie Mary Boy, yielding about 4.3%. In the high yield space, they suggest taking a look at the mainstay McKay High Yield Corporate Fund. That's yielding about 5%. And then they talk about some closed-end high-yield funds that offer distribution rates as high as 7 to 8%. How do they do that? They do that through leverage, which adds to risk, and many of these funds also trade at a discount to their net asset value. They recommend taking a look at Golf Hotel Yankee, PGIM Global High Yield Fund, as well as HYT Hotel Yankee Tom. Another one that they mention is the Invesco Dynamic Credit Opportunities Fund, 10% discount to net asset value, 8% current distribution rate. The symbol there is Victor Tango Alpha. In the municipal bond space, Barron's pointing out that if you're in that high tax bracket, munis still make a lot of sense, even though 10-year muni yields are about 1.35%, but that is 87% of the Treasury yield. If you're looking shorter in the 1 to 5 year range, you're looking at yields of about 1% on munis. They do mention a few closed-end munis. The Nuveen AMT Quality Muni Income Fund, NEA, November Echo Alpha, 1430. It's trading at roughly 4.5% yield, 9% discount to NAV. They mention a few others. I'll just mention one other. BlackRock Municipal 2030 Target Term Trust. Symbol there is Boy Tom Tom. It's a 3% yield, an 8% discount to net asset value. And this fund does have a wind-up date in 2030, meaning the fund is expected to liquidate at whatever the net asset value is in 2030. Mention a few other dividend-paying stocks mentioned in Barron's. In an article on REITs, or real estate investment trusts, a portfolio manager mentioned SL Green, symbol Sam Lucky Golf. SL Green has a large real estate portfolio concentrated in the Northeast, specifically New York, but the portfolio manager pointing out that it trades at about a 30% discount to net asset value. He said they've been doing a good job in terms of managing their portfolio. They've been buying back stock. And the yield is about 4.24% for Sam Lucky Golf. Another dividend-paying stock mentioned favorably in Barron's is Kellogg's, symbol K as in King. Stock was a poor performer in 2017, falling more than 20%, as Kellogg struggled with declining cereal sales and changing consumer tastes. Barron's suggesting that a change is possible. They recently brought in a new CEO. He's been there about 2 years. He's a former Coca-Cola executive, and he's been cutting costs, and he's been rolling out existing products in smaller packages, trying to create snack-sized packages that are available, for example, at convenience stores. And Barron's thinks that this strategy is starting to gain traction, not just here, but in emerging markets as well. Kellogg's trading around 16 times forward earnings, 3.7% dividend yield. Jason English, a Goldman Sachs analyst, calls Kellogg's by far the most attractively valued stock among snacking peers, and adds that it's a very healthy discount to the consumer packaging industry overall. He expects the two engines for growth will be improved performance, accelerating organic sales, which includes the impact of acquisitions and divestitures, and better margins. Better margins coming from the fact that snacks now make up over 50% of Kellogg's business, and cereals down to 38%. If you go back to 2000, cereal was about 76%. As recently as 2010, cereal was about 60%. Now cereal down to 38%, and the snack business representing more of Kellogg's business, and perhaps the stock not getting the appropriate credit. Another dividend stock in Barron's, Johnson & Johnson, dividend yield 2.9%. Johnson & Johnson in the news, lots of headlines about losses in the courtrooms as they're being sued for multiple products, including opioids, and Barron suggesting that the negative headlines perhaps represent an opportunity. They don't dismiss the fact that there is real litigation risk, but they think that Johnson & Johnson can sustain the litigation risk, and they think at 14 times earnings and a 2.9% yield, the stock represents a favorable risk-reward ratio. One more stock I'll mention, just thought this was an interesting one. This is contrarian, and this is General Electric, mentioned favorably by the man David Giroux, who runs the T. Rowe Price Capital Appreciation Fund. That fund has beaten the S&P over the last year. It has beaten its competition by about 4 percentage points a year over the last 10 years. The fund is about 60% stocks, 40% bonds, yet has returned the same return as the S&P 500 with a lot less volatility due to that bond exposure. And he has just recently changed his thesis on General Electric. He said we didn't own it until recently. He is a fan of Larry Culp, the man who is now running General Electric. He said he's confident that Larry Culp can and will turn around General Electric. He points out he doesn't own GE for the upcoming quarter or the upcoming year. He's looking for free cash flow in 2023 is what his focus is on. He says the crown jewel at General Electric is the aerospace business. That's where most of the value is. It starts with people on planes. He points out there are 5% more people on planes each and every year throughout the world, and he says that growth has been consistent. And what he also points out is that building a jet engine plane is not going to be something that's going to be automated out to machines or robots or computers anytime soon, and therefore he feels that the competitive position remains strong. He does acknowledge that GE is very complicated, but he says we love complexity. That gives us a chance to dive in and arbitrage the difference between what we think and what everyone else thinks. So thought that was interesting, that contrarian thought. Also want to mention potential victim in the broker wars. We started by talking about the zero commissions on equity and option trades, and it's interesting to note that one of the potential losers of that zero commission are ETFs, exchange-traded funds. Now, intuitively, you may think to yourself, why is that the case? That may be the case because you may realize or remember that many of the discount firms were offering no fee or no commission trading on ETF. Now that individual investors can electronically trade any security, any equity security without a commission, it's possible that they will choose individual stocks instead of choosing ETFs. And it's interesting, State Street and Vesco, two big ETF providers, and as well as BlackRock, were all down anywhere between 4 and 9% last week on this news, on concerns that the demand for ETFs may be diminishing. I mentioned that there was a counter argument in Barron's on why the long rally in bonds might be near its end. This is an article in Barron's, and the thesis here of this article is that some of the lower interest rates are being driven by central bank policy, by quantitative easing, and if you sort of read the tea leaves in the last few weeks or the last month, there may be hints of a beginning of reconsideration by the most aggressive practitioners of quantitative easing. The Bank of Japan recently hinted that it might reduce purchases of longer maturity securities, resulting in a rise in the Japanese government bond yields on the longer end. European bond yields also started to tick up after Mario Draghi at the ECB said that he was a fan of continuing quantitative easing, but it turns out that in the minutes of the European Central Bank, some of the other bankers had concerns about continuing quantitative easing, or QE, and Mr. Draghi's term is running out, so his replacement may have a different view on quantitative easing than he does, and those factors could influence what central banks do going forward. That's everything I've got. I'm going to turn it over to Brad, talk some more about the bond market, and let us know what's going on. Good morning, Brad.
Hey, Keith. Good morning, everyone. Happy Columbus Day. It's one of those odd days that I never understood why they close the bond market and keep the equity market open, so I apologize to those who have to work all day today. But just a couple comments apropos to Keith's. One, as far as rates are concerned, opinions are opinions. Economists seesaw like 3-year-old children. It's unbelievable how quickly everyone's attitude changes on the drop of a dime. You have to stay the course and don't fall for everyone saying we are definitely going to negative rates because the rest of the world is at negative rates. That doesn't mean anything. We can be in a vacuum here in our country. We do have to keep an eye on what's going on, but anything can happen here, and anything has happened here as long as I've been in the business, it's almost 30 years, and as long as the history books have said. So stay the course, because rates can go anywhere. And I've seen it happen with no warning that they can go much higher or much lower with no real warning at any moment.
Thank you, Brad. Okay, everybody, have a fantastic week. Thank you for listening.
Thank you for listening to Mr. Keith Lanton. For more podcasts, please visit our website, www.lanternwa.com.